The dominant strategy in the modern startup ecosystem is straightforward: raise as much institutional capital as possible, accelerate top-line revenue, and drive toward a high-profile exit. Most of these ventures burn out. There is a structural contradiction built into this model. Aggressive revenue expansion frequently triggers a fatal liquidity crisis, bankrupting businesses that appear highly profitable on paper. Above the surface, we see an aggressively climbing revenue line, but this metric acts as an illusion. Below the surface, the volume bar chart representing actual cash reserves rapidly draining to zero, pulling the entire enterprise down with it. Founders mistakenly equate gross sales volume with actual financial and structural strength. This chart outlines the common founder's trap. Looking at the left panel, we see a scenario where sales volume rises rapidly, but profitability crashes simultaneously because the marginal cost of delivering each new unit exceeds its selling price. Early-stage ventures lack the procurement advantages and scale efficiencies of large corporations. During initial expansion, their cost structures remain unstable, turning aggressive growth into an immediate liability. There is an alternative path to scale. It relies on strict profit discipline and risk management, rather than massive injections of venture capital. This is the founder's edge. It is a framework for engineering a business that remains structurally independent by using internally generated cash flow to fund its own development. To survive the early stages of a venture, founders must abandon top-line vanity metrics. Survival requires mastering the microscopic operational mechanics of margin, liquidity, and risk architecture. Strategic indicators like monthly revenue or total operating expenses are useless for diagnosing a startup's health. To assess viability, analysis must begin at the atomic level. This chart establishes unit economics as the firm's core metric. Under the key economic equation, subtracting variable costs from the selling price yields the contribution margin, the fuel for growth. In break-even analysis, a 30% margin accumulates capacity, while a compressed margin creates structural fragility. Scaling a compressed margin is a mathematical danger. If a founder relies on heavy discounting to acquire users, every new sale actively deepens the operational deficit rather than closing it. Under this flawed model, the startup effectively pays the market for the privilege of unprofitable growth. Strategic pricing decisions serve as the primary lever a founder can use to manipulate and protect that contribution margin equation. This chart compares pricing methodologies. On the top right, cost-based pricing ignores customer perception, leaving margin untapped. The superior path is value-based pricing, working backward from the economic benefit delivered to the customer to capture higher margins. Pricing offers enormous mathematical leverage. A tiny percentage increase in price creates a disproportionately massive increase in retained profit, simply because the operating costs required to deliver the product remain static. Without rigorous unit economic discipline and value-based pricing, every new customer accelerates the venture's demise. In these cases, venture capital funding acts as a crutch, masking poor economics rather than functioning as an engine for growth. Once the individual transaction unit is profitable, analysis shifts to the broader cost structure required to deliver that unit consistently. This chart illustrates how different cost structures react to scale. Looking at the left to right contrast, we see the rigid trap where large fixed costs weigh the business down, compared directly against the effective, disciplined approach, where flexible gears expand and contract based on demand. Heavy fixed costs, like permanent staff and long-term leases, create dangerous operating leverage. When demand drops or the market contracts, those fixed obligations remain, amplifying the firm's financial risk. Disciplined founders deliberately delay scaling their fixed infrastructure. They build modular, outsourced cost structures that adapt instantly to changing market conditions. This reveals the core paradox of startup accounting: the massive discrepancy between an enterprise that is profitable on paper and the actual liquidity it possesses. This diagram maps the cash conversion cycle.
Focusing on the bottom left panel under the dual dimension of transactions, the chart shows a funding gap that grows aggressively alongside sales volume when payment timing is misaligned. When a startup grants extended payment terms to clients but pays its own suppliers immediately, it acts as a free bank. The startup is financing its customers' operations out of its own pocket. This danger compounds. As sales volume increases, the working capital funding gap widens proportionally. The business bleeds dry while fulfilling profitable orders. The operational solutions are precise. Founders must artificially shorten the cash cycle by implementing staged invoicing, utilizing milestone billing, and offering early payment incentives. Staged invoicing breaks large contracts into sequential paid milestones rather than waiting for completion. Rapid scaling without synchronized cash flows mathematically guarantees a liquidity crisis. A slight delay in receivables transforms paper profits into a corporate death sentence. The strategic question is how an unfunded venture survives systemic operational shocks without a massive venture capital buffer to absorb the blow. The first defensive framework is minimum viable investment, a strict information acquisition tool, restricting capital solely to the lowest amount required to validate the economic logic of the business. This image clarifies the MVI process. Focusing on the center panel, we see the transition from the validation phase, where tiny amounts of capital buy market feedback, into the expansion phase, where capital deployment directly follows confirmed market evidence. Deploying high sunk costs before validating demand destroys a venture's strategic optionality. It locks the founder into a rigid path with no capital left to pivot. The second defensive layer is contractual risk transfer. This is the legal and operational strategy of redistributing exposure to external partners. This chart illustrates the rule of contractual risk transfer. Looking at the center-left section detailing the logic of risk ownership, we see that if a supplier controls the manufacturing process, that supplier must carry the liability for defects. Risk ownership aligns with operational control. Founders cap their downside exposure using specific mechanisms. They enforce aggressive service level agreements, mandating financial penalties for poor performance. They use strict indemnification provisions and write liability limits into contracts. Shifting payment terms legally and financially moves exposure away from the founder. Requiring non-refundable deposits forces the client to share the financial commitment during the execution phase. Corporate resilience is engineered by building an architecture where external shocks bounce off the startup and land on better-positioned commercial partners. Mastering these granular financial mechanics yields the ultimate strategic outcome, the founder control architecture. This diagram contrasts organizational structures. Focusing on the central pillars, we see the bloated, red tape hierarchy of large corporate bureaucracy on the left, compared directly against the hyper-agile, direct decision authority of a small venture on the right. Retaining strict ownership and avoiding unnecessary board approval layers enables immediate execution. This lean structure generates a massive competitive advantage, known as information asymmetry. Information asymmetry occurs when one party possesses deeper, faster, or more precise knowledge than others in the market. This diagram shows the flow of that knowledge. The founder sits at the center, receiving direct data pulses from customers, suppliers, and operations. This proximity provides superior, unfiltered intelligence compared to the aggregated, delayed reports relied upon by corporate hierarchies. Direct intelligence allows the founder to adjust pricing, shift supply chains, or pivot operations weeks before heavily funded competitors even perceive a shift in the market. Strategic independence is ultimately powered by unmatched operational velocity. Building an unkillable venture relies on three distinct pillars: absolute clarity of economic design, rigorous margin discipline, and proactive contractual defense. The most enduring startups do not achieve scale by raising the largest rounds of capital. They win by engineering a self-sustaining machine where every unit of growth produces undeniable financial strength rather than structural fragility.